Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you stay ahead. Today on the show, special guest Jack Mintz joins us. Jack is an economist and President's Fellow at the School of Public Policy at the University of Calgary. He discusses Canada's economy and challenges Canadians face in this current market environment, plus he highlights the recent changes to capital gains taxes. Jack shares his thoughts on the capital gain inclusion rate, touching on both the individual and corporate levels. He points out that the capital gains inclusion rate is increasing from 1/2 to 2/3. For individuals, there is a threshold of $250,000 where the 50% inclusion rate still applies. Most individuals won't be significantly impacted by this change, he says, but other taxpayers like corporations and trusts are affected from the first dollar. These new rules will come into effect on June 25th, and the impact of these changes on the market is uncertain and will be observed over time. Jack also touches on the inflation story and how he does not see inflation dropping again anytime soon, and that it's going to take some time to get back to 2%. In terms of international investments, Jack believes that the current market environment is a deterrent for foreign companies considering acquiring Canadian firms. He points out that Canada is struggling to attract investments and how the country's real per capita GDP has been declining for the last 6 quarters. Jack also addresses concerns about population growth, productivity output, and M&A synergy. This podcast was recorded on June 25th, 2024.
It's been something for advisors, certainly over the course of the last little while, trying to get changes made. Probably not everyone made changes. Did you make changes necessarily?
No, I decided not to.
You decided not to.
Yeah.
So people just have obviously considered and decided what's best for them individually. Fascinated to get your thoughts on the corporate level of what corporations ultimately are going to be paying because of the capital gains inclusion rate. There's the personal side, there's the corporation side. Just spell out the difference between them and then we'll dig in.
Okay, well, I think it's very important to understand the differences. And one thing about taxation, it can be very complicated at times.
That's why we're asking you.
And this provision is somewhat complicated. So we have to remember that when it comes to personal capital gains, that people will get a higher inclusion rate on capital gains that are in excess of $250,000 in a year. And that increase is going to be in terms of, instead of including half your capital gains as taxable income, it will be 2/3 of your capital gains that will be included in income. And it's only those capital gains in excess of $250,000. That's the personal side.
Yeah.
The corporate side is much different. There is no exemption. Right. So the corporate capital gains tax rate rises from 1/2 of capital gains will be included in corporate taxable income. Mm-hmm. It will rise to 2/3 of capital gains will now be included in corporate taxable income. And there's no exemption. So it's a full whack. And in fact, when you look at the revenue numbers of the government, over half of the revenues are coming from the corporate side, not from the personal side.
Well, for sure. I mean, that's where all the money is. Yeah.
Yeah.
So let's go into what it means for a corporation that has had, either a great year, a normal year, or, struggling to have an okay year. In any case, whatever they're making on the revenue side of things, on their profit side of things, is going to get dinged in a more significant way. How does this work for a company? I'm going to begin with the M&A piece because there's lots of different pieces here. But so for a company that is thinking of buying something, or a company that looks to be sold and be bought, what is the piece here that they're now going to rethink?
Well, I think there's going to be 2 impacts in a sense. First of all, when corporations are going to be selling their assets, whether it's a building or a machine or shares in a company,
right?
They're now going to have to pay more capital gains taxes, and so that will, of course, be a bit of a deterrent. And in fact, it could have an impact on mergers and acquisitions. In fact, there's a study that came out that showed that actually the corporate capital gains tax actually reduces mergers and acquisitions in Canada by $1.1 billion. Per year. So, that's under the old existing capital gains tax rate. So that's an example where there will be an impact in that sense. But there's another impact too, and that is when you increase the corporate capital gains tax rate, that's roughly about 7% of corporate taxable income. And so that's equivalent to actually increasing the corporate tax rate by 0.3 percentage points, which currently in Canada is roughly, the federal provincial rate is roughly 26%.
Depending on the province you're in, yeah.
Yeah, depending on the province. So it's like raising the corporate income tax rate from 26 to 26.3%. And that, of course, is going to deter investment. And of course, there's some types of firms where corporate capital gains is very important, like in venture capital. So the impact could be even much bigger for those types of companies.
So venture capital, PE, any company that's going to go and buy something, fix up the company, and then try and exit within, 5 years, whatever the standard is, it changes their entire calculation, doesn't it?
Well, that's right. I mean, it certainly will have an impact. And the question is how big the impact will be. In fact, this is kind of like in preparation for today, so this is really quite new.
Yeah.
My colleague Phil Bizel and I, we have actually now estimated the impact of the capital gains tax rate increase, particularly the personal one, not the corporate one yet. We have to still do that. But it will actually discourage investors from holding equity shares in Canada, and that impact could mean a loss of investment of capital stock in Canada of $88 billion, up to $88 billion. $88 billion in the longer run. As economists always like to talk about.
Yes. Okay. So thread this together for us. So you have an investor is looking to make an investment in a particular stock, but ultimately, if they do make a very good investment and there are lots of gains, and they get dinged on the way out to a higher extent, they are then less likely to invest in that company? That's where
that's exactly right. And it basically, they get a lower after-tax return to invest in Canadian companies for that reason. So it's obviously going to discourage investment to some degree. Now I have to remember that there's $4 trillion in capital stock.
Right.
So it's about a little over 2% of capital stock that will fall, but it's still a meaningful number.
It's the rate of inflation we're aiming for as well.
Right.
Speaking of inflation, just for a second, I do want to just quickly divert and ask what you think about the inflation numbers in Canada that came out this morning. They're ahead of expectations. Where do they fit in the trajectory of what's happening on monetary policies?
Well, I think it's definitely bad news for those people who thought that inflation was going to drop again this month.
Did you think inflation was going to drop? Maybe not today, but like over a medium term. What are your thoughts on the trajectory?
I've been arguing that inflation is going to take some time to get back to 2%. We have made some good progress. There's no question about that. But it's very sticky. And it's, for example, wage settlements are still running in the 4% range. Right. And that really impacts, especially on services, because services are highly labor intensive. So if your wages keep rising,
and that's 4%, that's where we saw the service.
Yeah, so your inflation rate is bound to go up more as a result. And so I think I've been of the view that it's going to be tougher. I don't get too excited about 1 month to 1 month calculations because things change. But I think today is a reminder that it's going to take some time to reduce inflation. And in fact, if I was the Bank of Canada, I would hold off on another reduction until maybe at a later time if things show up better over the next month or two.
Yeah, so you'd want to see a few more months in a row of inflation coming down.
Yeah, we're still uncertain. And the last thing we want to do is to take the foot off the brake. Yeah. And all of a sudden we start having acceleration in speed that is going to be very harmful to the economy, and that's what happened, years ago. But right now, I think the Bank of Canada has been playing a very good role in trying to use interest rates to quell inflation. But it's going to be a lot tougher to get down to 2, let's say from 3 down to 2, than it was to get from 6 down to 5.
Inflation is a big story that this country is dealing with, that a lot of countries are dealing with. Just the higher inclusion rate for capital gains, is it is it just sort of net neutral on the inflation story? What does it do one way or the other?
Well, I think we have to remember that the increase in the capital gains tax rate will have an impact on investment, as I've just now given you as a number.
Again, so we're sort of threading through how does this hit inflation? Right. Does it? Maybe it doesn't.
So you're cutting back supply.
Yeah.
And that actually makes it more difficult to reduce inflation if you have less supply in the economy relative to demand, putting it in easy microeconomic terms. So yes, it doesn't help on the inflation front. The capital gains tax rate will hurt in that sense. Where it does help a little bit is give some revenue to the government, so they're not running as big of a deficit.
Is it going to be put directly to
inflationary?
We sort of have been told that they will, but
they've been trying to keep to their $40 billion deficit target for this coming year, and I think this was one of the changes that they were hoping will give sufficient revenue, especially since they delayed implementation after the budget, hoping people will cash in on their assets and give a one-time increase to the government in terms of capital gains. But I don't think the government is out of the woods yet, because we also have other years, and I think people are very concerned about the sharp increase in spending in recent years, and it seems to be continuing. And that actually isn't helping monetary policy. Fiscal policy is not consistent with monetary policy right now. And in fact, it is pushing up demand, and as a result pushes up inflation. And even with the capital gains revenue coming in, we have to remember that's for this year, it's roughly $6 billion, which is a small amount relative to the total amount of revenue that the government brings in.
Tell us a little bit, if we go back to the M&A story, the piece that it would eat up. We were talking about this earlier. Is sort of the synergies part of what you would gain out of M&A. So you've got two companies, you put them together. Part of the savings ultimately is the synergies, because there would be overlap on the administration or other areas. Is that in this paper? It seems to be pointing to the fact that would be eaten up. Just tell us a little bit more about how that works.
Well, I think we have to stand back and ask the question.
Should we name this paper European Economic Review from 2019? Very interesting.
Yeah, it was published in the European Economic Review. It looks at a whole bunch of countries. Canada was one of them, and that's one of the nice things is they actually had results for Canada, which you don't always find in academic papers like this. So it really is worth, I think, people to have a look at it, and they may want to get the full title of it, which I don't have it in my hands right now.
Okay, we'll put that up.
But in terms of if we step back, you have to ask the question, why is it that mergers and acquisitions can be good things? Right now, the Competition Bureau is very worried about mergers and acquisitions because they're worried about it creating concentration in markets and higher monopoly prices, et cetera, et cetera. But actually, mergers and acquisitions play a very healthy role in the economy, because it allows companies to buy up other companies and replace management. And if managers are kind of slow and they're not doing the very best that they could do for shareholders, somebody might come along and say, oh, I can acquire that company, and actually there could be very significant gains to shareholders, as well as to customers and others who might get better service, et cetera. And mergers and acquisitions are actually a very important part of a dynamic economy that can lead to a change in management and to better management of companies. And so that's really the important economic gain. Sure. And some of that is reflected into what's called synergy gains, because when you combine companies together, they can cut back some overhead costs, some back office expenditures that they're doing, or they might be able to close up some types of businesses that are not functioning very well. And so those are some of the gains that could be associated with mergers and acquisitions. And I may have forgotten the exact number that this paper estimated in terms of Canada, but if I recall, I think it was something like $100 million a year that synergy gains that we lose as a result of corporate capital gains taxes.
So if we sort of go to the story of, is Canada open for business, which is whether international companies wanting to buy a company in Canada are allowed to, that has a whole sort of policy piece of a yes or no. But also, is this a deterrent ultimately for an international company that may want to buy a Canadian company and make it one of their subsidiaries?
Oh, absolutely, because because Kane's subsidiary would be earning corporate capital gains.
Right.
But I think we have to remember that investment is driven by a number of factors. How well the economy is doing, but also things like taxation, regulatory policy, things like that can deter investment. And there are some good things about Canada. We have very good human capital, very well trained individuals. That's something many companies worldwide do remark upon Canada. But we right now are doing very poorly in terms of attracting investment. In fact, we have more capital that's leaving the country than coming into the country, and that I think is a very serious issue. And in fact, even more concerning is the fact that our real per capita GDP has been dropping for the past 6 quarters, and I would argue it's going to continue dropping this full year. And whether it'll go up next year, I'm not sure, because all our growth is coming only from more people coming into the country. And in fact, there's more people coming into the country than the economy is actually growing, which is why our per capita GDP is dropping.
Right. Yeah, it skews a lot of different things in there. Could, Jack, this be overruled by another government in the future?
Possible. I mean, it may be that if the Conservatives get especially after last night's shocking election in Toronto, where St. Paul's riding, I forget the full name of the riding, but the one that Carolyn Bennett had. That was really quite an upset for the Conservatives to win after she was winning that riding with like 25 points advantages and 30-point advantages. So
big change.
That's a big change.
Yeah.
So we might see a Conservative government after the next election, and I think they will be very concerned about this whole, decline in per capita GDP. They're going to be concerned about the lack of investment in Canada, and they already said they're going to create a tax reform panel to look at this issue and to see what sort of changes would be appropriate. So
I mean, they certainly could. It's policy. They can change policy.
Right. And I'm not saying they're going to withdraw it entirely, but there may be some sort of changes that might maybe take away some of the important sting that might be quite relevant.
A number of other questions. There's some of the things that you touched on earlier. Let's have you just kind of circle back a bit. What do you think, Jack, was the government's motivation to go ahead with the capital gains tax changes?
Well, I think two things. I think probably three things.
Okay.
One was political. This is a government about redistribution and taking from the rich and giving to the poor. And so they viewed this as another policy to pursue. The second argument, I think, is they wanted revenues to try to deal with their deficit targets and to allow for more spending. And I think this is where I think the big debate comes in, because it would be one thing if the capital gains tax rate was increased, but then the money was used to cut personal tax rates.
Right.
But instead, it's being used to feed the beast, so to speak. And the third is, I think, a tax policy argument where since 2000, we've been lowering the corporate income tax rate, especially up to 2012. It went from 43% down to 26%. I'm talking about the combined federal provincial rate on average across Canada. And because of our integration of corporate and personal taxes, as we lowered the corporate tax rate, we also increased the dividend tax rate by reducing the credit, which was used as an offset for corporate taxes paid before profits were distributed to investors. However, the capital gains inclusion rate, which was at 50% in 2000, never went up to kind of go along with that dividend tax rate. And since 1972, there's been a policy of the personal side to keep capital gains tax rates roughly aligned with the top dividend tax rate. And that has gone out of sync. So there's a tax policy argument on the personal side. However, on the corporate side, you get a different argument, because corporations don't pay taxes on dividends they receive from other corporations because it's already been taxed.
Right.
But they do pay capital gains taxes on shares that they hold in other corporations and assets as well. And so there's a double taxation of capital gains. And so actually raising the corporate capital gains tax rate, we actually created a bigger non-neutrality at the corporate level, even though we're reducing it somewhat at the personal level.
Right. So your average investor taking a look at this, just to sort of bring it back to that, is looking at companies that are dealing with this. I mean, they're looking at companies to invest in that are dealing now with this different sort of nest of issues.
That's correct. And we also have to remember capital gains taxes. There's all sorts of issues involved. You know, the capital gains tax applies to nominal capital gains. They're not adjusted for inflation.
Right.
And so you buy an asset back in 1980, like a cottage, and you sell it in today, a significant part of that capital gain is just due to inflation.
Sure.
It's not due to any real capital gains that you're earning and real income that you're earning.
Wow, think about that. I mean, that's massive. Okay, a couple other questions. What can Canada do to attract more businesses of the G7 countries who are the least productive? Yeah, let's go to productivity.
Well,
it's a big topic, but
it's a huge topic,
I know.
and I've argued in some of my articles that there's no silver bullet here.
Right.
I think we need to do a lot of things, but I would argue that what we need is something like we're open for business.
Okay,
And
I
I
mean,
think
and
that-
this is exactly what this capital gains perhaps is pushing back against.
Exactly, and so the open for business means that we're going to do a number of things to try to attract capital, whether it's regulatory changes, whether it's tax changes, or even cutting back the deficit, because when
Right.
investors look at these large deficits that are accumulating, and over time, that means governments will likely raise taxes in the future, and that puts off investors from investing in a country.
There's a question here on essentially immigration, which you mentioned a little bit earlier. This is the idea of, do you think the population growth will slow down in 2025? And you might add to that, what's the impact, the GDP impact, when you're looking at it on a per capita basis?
Yeah. So this is an important question. So first of all, we've been having much faster increases in population growth than we've had for some time.
Yeah.
They're roughly in the 3% range. And it's reflecting not only the increase in immigration numbers to 500,000 per year, which was adopted a couple of years ago, but also the very significant increase in temporary non-permanent immigrants, which includes students coming here on student visas that can work,
Summer
as well as
workers.
temporary workers that come in. And that number has been, over 1 million a year. That number is going to be cut back, and we'll have to see how much it's going to be cut back by the authorities.
Okay.
But we're still, in my view, likely looking at 1 million people coming in still per year, which is a little bit over 2% of Canada's population. So it may not be growth of 3% in population, but 2%. And then the question is, what will be our per capita increase? Right now, our per capita increase in real GDP has been negative. It's been like minus 2%.
Because there's more people. It's sort of a flooding effect,
Right.
isn't it? Yeah.
Yeah. So, and this gets back to the productivity question. If we don't start improving our productivity and getting more output per working hour in this country, we're going to have a serious issue in terms of falling GDP with more people coming into the country.
I want to ask you a couple of questions about some of your articles, and this is more like the interprovincial story. The corporate taxation is a big piece of this story because it can be, there's corporate tax at the federal level, but then there's the provincial level, and some provinces are much more attractive to on a personal taxation rate, but also housing prices, as well as the corporation story. Talk a little bit about, you speak about interprovincial migration in one of your articles, but maybe just sort of lay the overall story on the table for us, and then maybe we can talk about the migration within.
Well, actually, I was chair of the Alberta Premier's Economic Recovery Council when Jason Kenney was the Premier from 2020 to 2022. And
Very recently.
I think Alberta is a really good example of what happens when a jurisdiction gets its act together and becomes open for business. In fact, when Kenney was elected in 2019, he said, we're changing things. We're not going to start raising tax rates like the NDP were doing. In fact, we're going to lower the corporate rate from 12% down to 8%, which he did, in order to attract business. He said we are going to get our house in order. We're going to eliminate our fiscal deficits, start cutting back our debt. But also we are spending on per capita terms, like for healthcare and education, more than the top provinces or the largest provinces in Canada, and we're going to go down to their level, which they have done. They've actually constrained
Why were they
spending.
spending more? Oh, it was from previous government, was it?
Yeah, this was from previous years, including previous conservative governments, progressive conservative governments, who.
I mean, those are the big ticket items in a province: is the education and the health.
Education and health are the two largest ones. No question about that. And so they did do that, and so Alberta had a lot of success in turning the situation around. But I would say that message of being open for business was very important, and that started attracting more businesses to come to Alberta. Not just, and of course the recovery in oil prices, no question, had a big impact. But it wasn't just that, because there were a lot of new businesses that were coming into Alberta that weren't considering Alberta before. And a good example was the venture capital companies that have now really grown in Alberta recently.
Any other provinces, areas of the country that are either electing governments to put that sort of thing into action? I mean, do you see any movement anywhere else?
No, my biggest concern, well, Quebec has often they love to micromanage the economy with very specific incentives, but they do try to drive more businesses coming to Quebec, although their long-run history has not been entirely successful with all this micromanagement of the economy through special incentives. And in fact, my favorite one from a number of years ago was a special incentive for pig manure farming in Quebec.
That sounds like you could get a good article out of that.
I've mentioned it in one of my articles a long time ago, but it's kind of a favorite example. But Quebec hasn't done too badly. In fact, their growth has improved to a certain extent. The one that really worries me most is Ontario. Ontario productivity is very poor. Yes, they're throwing money now at EV battery operations along with the federal government. We'll see how this industrial policy, how successful it's going to be in the coming years. But there's a lot of other industries in Ontario, and the productivity rate in Ontario is very poor. And in fact, even the auto industry has had a low productivity in terms of the amount of output per working hour that's produced.
So what do we need as sort of a final thought on, particularly on capital gains, about Canada, productivity, the story that we've been digging into here? Where does the capital gains story for corporations fit into the overall, let's say, next 2 to 3 years? What impact is it going to have? You put it into numbers, but just sort of what might we see, or what are you watching?
I'm going to be watching for potential tax reform in the country, and I think the changes that will be made to capital gains taxes will depend on how we want to rejig the tax system in Canada, and I think that's going to be probably one of the most important ways, if we want to become open for business, is to think of some very significant changes to the tax system. One of the big issues, and I've talked about this in a paper that I wrote on Big Bang corporate tax reform. I don't think marginal changes to corporate tax will change it very much. But if we really do a major change to the corporate tax, we could get a lot of new investment. Example, or the one that I talked about, is moving to having a corporate tax on distributed profits only, and reinvested profits that are put back into the firm into new investment would not be taxed.
Okay. It's still sort of a capital gain story. It's when you're getting out.
Yes, and it would, there would be adjustments made on the personal tax side, et cetera. But the main point is that it's worked really well in Estonia. It's worked well in Chile in the past. It's worked well in a number of countries, and it's a very different type of system, but one in which if we did that, I can tell you, American companies and other countries and companies from other parts of the world will be looking at Canada a lot differently than they are right now.
Fantastic. Jack Mintz, Dr. Jack Mintz, thank you for joining us here on Fidelity Connects. Delight to meet you.
My pleasure. Thank you.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. While visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.